It is now time for our Trader Talk segment with Brett Manning, Chart Trader. Good morning, Brett.
Good morning, Jim. How you doing?
I am doing quite well. Are you doing better? I know you had some sickness going around.
I'm doing fine. We're good.
That's good. So it's been a little while since you and I talked, I think. So I'm trying to think about where we last left off, and honestly, it's really not all that much different from what we left off maybe a couple weeks ago when you were suggesting that there could be potential bullish tone to the market based on the sentiment indicators, and you went out with a little blurb today that indicates the same type of thing. Why don't we talk about that a little bit and what you're actually seeing in the markets?
Well, so I mean, I think that we have this persistent sense of a kind of doubted market all the way up, and that is, that doesn't necessarily mean the market has to go higher. There are instances where you see poor sentiment lead to a poor outcome just because, the market is rising in prices and there's bearish sentiment. Doesn't mean that the money that's pinned to the sidelines ever has to come into the picture. The way that I've expressed it in the past is there's kind of a binary outcome battle between two sides. One is the side that's in the market that doesn't buy the idea that we are seeing an imminent cyclical rollover, and those folks aren't selling. They're holding on to their positions, they're riding it out, and it kind of forms a sort of seller's strike context, which we'll talk more about in a second, because I think it's an interesting idea juxtaposed to the idea of a buyer strike. And then the other side of that battle is people who've just basically decided that in one form or another this cycle is done. Maybe the market runs up a little bit further here, but a year from now or a year and a half from now, we're going to be trying to wade through a difficult recessionary period where we don't have any fiscal tools. And I think that is the argument, and it doesn't mean that one side or the other is necessarily going to be proven wrong over the very near term. Eventually one side or the other will be proven wrong, and it can go either way. I mean, it really can. If we start to see signs that just apart from risk acceptance and apart from sentiment, if we start to see a gradual procession into recession, then the people who have been holding on to positions are going to eventually get on the offer, and we'll bang things back down. But typically, so given that, think of all of that as like a caveat. Typically, strategically, backtesting, you'll find that situations where the market rallies in the face of continued pessimism usually leads to at least a near to intermediate term positive outcome in the market, because usually there's something going on that people aren't appreciating. People have a more headline-based fear of what's happening, and eventually we start to see those headlines turn around. And when they do, everything looks rosy at the same time, money comes pouring in, the market booms higher. That has been a consistent pattern. Where are we right now inside of this? It's tough to say. Now, one thing that I will highlight, I think that, and I've talked about this a bit lately, I think that right now the context that we have around the way that this headline narrative, the kind of game theory behind the headline narrative for the trade war, the way that it's playing out is just extremely reminiscent to me of the period that we saw in late 2017 when we were moving toward an eventual tax reform bill. You remember that process, the way the headlines were leaking out?
Mm-hmm. Of course.
Yeah, I mean, it was just like, if you imagine, let's say if you substitute the trade headline war with the tax cut war, China and the U.S. substituted with the Dems and the GOP. It's kind of the same process of these gradual tipping point moves toward here comes an eventual deal. And I think that for people who are in the market for whatever reason, it's really tough to want to sell positions ahead of the final kind of cherry on that sundae of the big news breaking that there's a deal. It's really tough for a portfolio manager to decide that they're going to move out of their positions, even if they see other reasons to do so, before we finally get that, that big headline of the trade war is over in some way. And so having that constantly out in front of us, like a carrot, in front of the kid riding the turtle with the carrot on the stick dangling in front of the turtle's nose, and the turtle just keeps walking forward. And this market is kind of like that turtle. And it was like that in late 2017 with the tax cut. Now, the big difference is, and I mean, I guess this is subjective, but the big difference is, to me, the tax reform bill had unquestionably direct implications for at least 1 to 2 quarters out in economic data. There was an arithmetic force to that deal. There's no question that it had to force certain economic improvements just based on people adjusting around the new legislative context. And you could question whether or not that's necessarily the case with the trade war. Perhaps it is, but I think that people can kind of get out in front of that a bit, and it's really debatable how much of a direct effect on the economy the trade war has had. I suppose it's a sentiment move, but you can look at what Chinese stocks are doing right now. They've already kind of priced in whatever advantage there is, I would say. So I'm not sure that you'd get the same follow-on response. So the real question here is, are we setting up for a kind of interesting sell the news situation that would have a number of different angles on it when we finally do get the headlines? And what exactly is the headline that we're looking for? I think that's the other point for discussion. And I would say right now it seems like the media is setting up for the idea that the big headline that's out in front of us isn't necessarily the signing of the deal. It sounds like it's more about the announcement of whether or not there's definitely going to be a summit between Trump and Xi. That kind of assumes the deal's in place. However, that headline already hit a couple months ago, and then the summit was canceled. So the market's already kind of been through that process. So I think that it's not actually off of that headline. I think it's more a case of kind of how things go after that headline, that there is going to be a scheduled summit. So we know, let's say there's a scheduled summit for 1 month from right now. I don't think that's the sell the news event, if there is a sell the news theme here. I think that probably it's as we get to within a few days of it. And it looks like the rhetoric going on back and forth is constructive. And I think at that point, if there's going to be a sell the news on this cherry on the sundae for people who've been kind of in a situation where maybe they see things like the yield curve inversion, which I want to talk about that too. But if you see this process where people think, hey, maybe this is setting up for some difficult times ahead, but the trade war has been such a persistent and important part of the narrative that I really can't sell in front of that headline if I know that headline is coming, then a couple days before that summit actually happens, I think is probably the point where you would start to see some of that market offer coming in. And I think that that's the interesting narrative where that's concerned as far as the parallel with what we saw in late 2017.
I think it's tough to handicap that big that big nuke bomb headline of the sell the news, because what we've seen are these little baby step type of progress headlines, and they just buy it. And I don't know that we get that big one. We have a deal coming, because this just seems to be playing out. And now we just saw this morning that they're talking about extending their commitments to the 2025 year, which just happens to coincide with the China rally cry, or the initiative of China 2025. I actually found that, I'm going to put my tinfoil hat on again, but man, I found that very interesting. That seems to me maybe a shift in some of the, if this is a tug of war negotiations, to me that sounds like China got the upper hand a little bit.
Well, so explain that to me. I'm interested.
Well, anytime I see coincidences like that, right? And
Sure.
And Trump, being the hard negotiator that he is, wants the upper hand, wants to be perceived as the winner on any particular negotiations. And to this point, China, I feel, has been kind of playing along with that notion. And now, granted, I don't know exactly when the commitment levels were supposed to be, but anytime you throw in something that is nice and convenient to the other side like that, it almost seems as if there was some type of leverage being gained by the other side, being China. And maybe there is an actual a shift that maybe China has the upper hand, and there might be a concession coming, but I don't know if it's going to be the quote unquote win that the U.S. side wants.
So here's where I will wholeheartedly agree with what you're saying. So I believe that underneath the surface, China has had the upper hand the entire way through, and that we would get to the point where it becomes more and more evident. So the reason why that's the case is because President Xi is not up for re-election in a few months. Mm-hmm. And that's key. He's president for life. Nobody's ever consolidated power, perhaps, with the question about Mao, but I think that this is even maybe more because it's more kind of world ratified. I think that Xi is probably the most powerful in the internal context of a major economy in the world, maybe one of the most powerful in the history of the modern world right now. He's got absolute status of leader for life. He's consolidated every single element of his party, and his party is as in control as it could ever possibly be. They've got control over all sorts of things that are much more direct because their whole machine is not based upon quite the same sort of democratic market system. So he can maintain that control, and they can actually do the things they need to do to continue to consolidate that. So he's got zero political risk at any real point here. And I think that Trump, is fighting for his re-election already quite clearly. So it's really tough for Trump to play the same game as Xi, and Xi can take a lot more risks without risking nearly the same thing. Trump needs this resolved in a positive way more than Xi needs this resolved in a positive way, I guess is the point. And so that's going to always be a better place to play from with every move for China than for Trump. And I think that China must have foreseen this by going through the process of naming Xi leader for life toward the end of 2017, a couple months before the tariffs started being announced by the U.S. And I think that was probably a strategic move. So in a game of chicken, we use this metaphor all the time. Xi is the one that can more easily unscrew the steering wheel and throw it out the window and then put a blindfold on and make sure Trump sees that. Like that's an easier thing for them to do because the consequences aren't the same. The administration in place in the White House could be out of the White House, just a matter of a little over a year and a half from now, basically a little over a year and a half from now, and that's just not the case in China. So I think that there's a lot of things that might start looking like exactly the scenario you described as we start to get to the end game. And I think that at the same time, the symbolism of 2025 may be important, but I don't think that saying that that's the time frame for manifesting all of the things that China commits to in a deal as being part of the notion of there being a deal. So I think that there is a grand moment of now we have a deal, and I think that it could be a little bit liquid in that the tariffs may be sort of modified and they could be kind of a running lever, and I think that's part of what we could get with the enforcement side, because you've got this issue that's still out there. You've got some highly abstract ideas that are going to be tried to be worked into this deal. When it comes to intellectual property transfers, like how you govern that, whether or not that's happening, it could be in the best interest of some companies who want to do business in China to do intellectual property transfers, and yet the administration in the U.S. wants that to stop as part of the trade deal, which means you may not even have fair reporting by those companies when they're dealing with China. So how do you enforce that? It's just an extremely tricky problem, and there may be no way to get absolute faith that once a deal is signed, it actually does what the deal is supposed to do. They're trying to get there, but it may be that this ends up as a situation where there's kind of left in place a few levers that the U.S. can consistently pull, and it may be sort of like that there's a tariff rate that becomes like a policy rate as to whether or not the U.S. is happy with how China's dealing with things over time. I'm not sure how else you solve some of these problems. So there, in that sense, there's not this one grand moment where the trade war is over, exclamation point. End quote. But there may be kind of a moment where the market feels that way or prices accordingly when you get to, there's a summit between Xi and Trump. It's definitely going to happen. We already know that Xi would never agree to that summit if he wasn't signing some document in the summit. So once that agreement is there, we got to get past the window where Xi could pull out because he starts to feel like the U.S. is using this now as that art of the deal moment where we can start to, throw in last-minute measures to try and sweeten the pot for us, and then he decides that's not the right thing to do, and then it gets taken off the calendar, and people find it in the government website like we saw in March. That's possible that could happen as well. But I think that the moment when we get to within a few days before that summit is expected to take place, and it doesn't look like things are on rocky ground with falling through with that summit, then we know that some piece of paper is going to be signed. And when some piece of paper is going to be signed, it's going to include something that's going to be a little bit tough to break because nobody wants to go back through this whole process. And then it just becomes a game of whether or not what people have agreed to is actually what they're holding to. And I think the market will look at that as something symbolically kind of like the end of the trade war between the U.S. and China, But you're right. There's going to be this constant process of whether or not it's really happening. There's going to be moments. We can just imagine Trump during this process eventually getting upset at something that China does and threatening to put it all back on the table and all sorts of moments like that. But I think we do kind of have, if there is a sell the news out of this, I think we do kind of have a moment that will be in place at some point where that will start to manifest itself. I mean, that's how I'm kind of gauging this.
And the other thing that I'm curious about is how much is the market, what would the market reaction be if it's a perceived loss for Trump? If we get the deal and you get to sell the news, and then all of a sudden the takeaway from the talking heads or whoever and analysts is like, this is not a good deal. Yeah, I guess so. But then that throws uncertainty on Trump's legacy, the re-election, and then what happens to the markets. I mean, that's a big sell of the news.
You're talking about perception of what's happening in reality.
Well, hey, and perception is reality.
We know right now. Well, we know there's going to be two parallel universes there. There has been with every single thing that's happened with this universe, right? I mean, there's going to be two parallel narratives, one going on the right, one going on the left, that define what's happened. And you know that both of them are going to be equally subjective and equally about trying to position for the 2020 campaign. So I think that it's going to be really tough to say that there is a particular narrative that has ascended to being the one that everybody agrees is the proper way to view whatever deal's in place. So I don't know if there's going to be any clarity about whether or not the deal's good. There's going to be a process of framing that's going to go on for people who want Trump to win and for people who want Trump to lose. And that's going to be facilitated by lots of people who are hired to do a lot of PR work. And I don't know if it's just going to get so lost in the mix. But we can objectively step back and say, and who knows if objective statistical reality is going to have anything to do with what people perceive, and that's a sad reality right now. But we will be able to see what the impact on the economy is through a number of different models, and there's a good chance, as is usually the case, that most of those models will roughly agree with each other, because we're dealing with things that are relatively easy to compute in terms of exactly which purchases are going to take place and exactly what sorts of controls, because they're going to be basic controls if there's a currency issue in terms of how they're dealing with the renminbi and all sorts of things. And I mean, again, the real wild card here is how people perceive, because there's this narrative underneath the surface. And the narrative is, we have these moments of history where different countries kind of ascend on some level, and the U.S. in particular, out of the fallout of World War II, kind of ascended into a superpower status that eventually, out of the fallout of the Cold War, became sort of a single pillar institutional context for the world. And we've had the British Empire did the same thing, maybe 50 or 75 years before that, and actually even further before that. But these processes, they're often kind of tied into different changes in technology at the same time. And right now, you've got an infrastructure being laid down on a number of different levels. It's really tying in everybody in the world into a digital landscape. And China is really making the play to say that they're going to be the superpower for the next century because they're going to be controlling that particular infrastructure. And I think that's the most important narrative underneath the surface. And that's why we have this kind of this mix into the narrative, this Huawei CFO and different perceptions and trying to propagandize which side Huawei's on. Are they really this evil company that's doing underhanded things, or is it just a way to frame things to get different countries to be on our side when it comes to letting them in and doing their infrastructure and a couple other companies in China? So there's this process of who's going to control 21st century information technology infrastructure. China's made a big play to say that they're going to be the ones who are going to control that, and that's really part of establishing them as the kind of the next big superpower to control things. And the U.S. is really kind of working to prevent that. And a lot of countries are working to prevent that. And I think that's just, a familiar narrative that's going on underneath the surface that's maybe not highlighted enough. But I would say if there's any one thing that's really underneath the entire trade war, it's probably that. And I don't know how, no matter what deal we get out of this, I don't know how that narrative is necessarily impacted, because you can't really make that an explicit part of a deal that you then enforce and China agrees to just play second fiddle for the next 100 years. I don't know how that could be a part of it. So a lot of this, I think, is just about kind of stopping this ascendancy. And it's tough to stop. I mean, there's no way that China's not going to be the biggest economy in the world. over time. I mean, that's just a matter of geographic boundaries. Per capita, it may not be, but they've got 6 times as many people. It's just where you draw the lines. If you have a centrally governed thing that has 6 times as many people, then as they get to anywhere near even a fraction of the same quality of life and per capita production level, they're going to be by far and away the biggest economy in the world. Like the U.S. with 300 million people can't possibly compete. That's, at the end of the day, that's that. There's no way around that. Unless we break China up into a bunch of separate countries, that's going to happen. It is utterly inevitable. And it's not really about anything other than population and the fact that that population is all under the same overarching political structure. So, I mean, the game is lost on that note all the way and without any question. And really the question is, do they control the sea lanes? That's how the UK rose. They control the sea lanes. The US kind of rose in a similar way. Now it's sort of like digital sea lanes. And if somebody wants to look at the situation like that, I don't know if there's going to be any way to judge whether or not that narrative was impacted by whatever deal we put together.
Wow, chart trader, that's a lot.
That's a lot. Well, that was a little bit of a tangent, but I think that's really what this is about on some level.
Yeah, no, and it's a great point. I agree. So, before we move over into the yield curve, I really do want to get your thoughts on the Chinese stock market, and I'm going to refer to A-shares. And I could make a case for 2 types of different trades, and I'm going to just base it very simplistically on looking at different time frame charts. I look at a daily chart on the A-shares and say...
We're looking at Shanghai?
Yeah, looking at the Shanghai, but I'm using the A-shares as a proxy.
Okay, no, that's fine.
And I look at it and it's like, wow, we're really off the December lows here. Man, I might have to be thinking of a short. Then I flip over to a monthly time chart, and I'm like, wow, are we on the verge of potentially breaking out into massively big momentum trade here in China? I don't know what to make of it. What's your take?
So, I mean, I would say that you've got, the same thing that we get in a lot of markets where on one time frame something is overextended, on another time frame, you could make the same case about emerging markets in general. If you want to look at the EEM on a monthly chart, you're going to see something that looks like, we've been consolidating since 2005, and here comes the breakout above 55 whenever it happens, and you're headed toward 100 or whatever. Like that, there's, you can go through that same process with a lot of different charts. And it's a related concept, quite frankly. So, I mean, obviously we're overbought on short term, but we haven't even gotten the trade deal headlines. And they have, as we've talked about, they have a lot of stimulus in place, and you have made the same point that I have, that stimulus is going absolutely nowhere. Even after they've resolved this issue, probably that's going to stay in place because they do not have an inflationary conundrum. And until that's so much pressure, until there's serious problems with the idea of where their inflationary situation is, the stimulus is probably going nowhere. Especially since, and I made this point the other day, Bloomberg went ahead and added them officially to the bond index, to the Bloomberg Barclays bond index. And that's a big point. I mean, one of the things that's a guard against them leaving stimulus in place is capital flight possibilities. And if they have massive amounts of money coming in right now from all of the world's major fund managers in the bond market and the fixed income space, and you're talking about trillions of dollars that's flowing in, those managers have to be a part of China now because they're benchmarked against it at this point. It has just been moved into that, and it's one of the biggest bond markets in the world, and of all of the big bond markets, it's got by far and away the highest yields. And so it essentially takes a disproportionate share of a bond fund manager's profit equation. If you leave that one out of your portfolio, you will trail the benchmark of all of them by a lot, as long as there's not some implosion there. Like that is the issue. You have to put your money in China if you're a bond fund manager, just on the basis of that indexing and benchmark equation. And that's a new development. When we're talking about capital flight problems, there's a ton of money flying into China right now, and they really can be a little bit more cavalier as far as where they set things that might depreciate the currency, because the capital flight is about the idea of currency depreciation in general for wealthy Chinese people. So they got a little bit of buffer there, and they can leave that stimulus in place as long as they want, probably after the tariffs, until they get to a situation where Chinese inflation starts running at 5-6% or something. So we have all systems go for China on that level, and that's precisely why it's booming like it is right now, because there's not a sense of the trade war is going to be taken off the table, then the stimulus is going to immediately go away.
Well, is there any trade that you're looking at in A shares? I mean, it's got to entice you a little bit.
I was looking at it before and I missed it. We talked about it maybe a month and a half ago.
Well,
that
yeah,
looked like
I know.
a buy.
Well, now it kind of looks like a sell. I mean,
Yeah, well, I don't know if I would want to sell it, though, given what I just said. Like, I understand that it will probably fall at some point, but, boy, you could say, if you look back at something like the Shanghai Index chart or the A-shares, the momentum that can build there is extraordinary. It isn't like other markets in a lot of ways. And maybe that's, I don't know whether that's information control. Some people like to say that it's just how Chinese retail investors behave. I don't know if I like that narrative as much. But the momentum that can build there, if you look at, 2015 in China, right before we started really watching the dollar aggressively advance, you've got, actually after we started watching the dollar aggressively advance, so you've got an enormous momentum trend where people started fading that thing, at 450, 500, it just kept going, got to 700, it just didn't stop, but day after day after day after day after day, and it was ridiculous looking. It tripled in a matter of months, and that's the main Shanghai Index. Did the same thing back in, I think it was 2008, when we saw crude oil take off to the upside. So there is a lot of sense, or 2007, there's a lot of sense of momentum that can build there that's really extraordinary relative to what you look at as typical equity markets. And I'm sure that the investor class of China has matured to some extent particularly over the past decade, and particularly going after some of the crashes that they have been through. But I am not at all going to be first in line to fade a high momentum trend in the Shanghai Index, especially when I think the stimulus may stay in place. That doesn't mean it won't pull back. It's not a setup I'd be comfortable with. So since I felt that there was a bullish setup and now we have moved this far this fast, it's really tough for me to see an edge.
All right, that's fair enough. It definitely gets on people's radars when you see a move like this, and sometimes you just need the voice of reason to talk you out of it, and I don't mind that whatsoever. All right, let's talk about the yield curve a little bit and your thoughts there. What is the best chart I can get on a futures chart? Which one do you want to focus on?
I don't think you can get any on a futures chart. If you look at the comparison, the important one right now is the difference between the 3-month yield and the 10-year yield.
Okay.
So you can find that on the St. Louis Fed. They have a nice chart. In fact, I can send you a link if you want.
Yeah, that would be great, and then I'll post it on the audio, on the Trader Audio Visual.
Sent to your screen.
Perfect.
Okay, so yeah, the big equation here, the idea is that we saw an inversion last week between the 3-month and 10-year. And the way that the whole situation plays out, over the last 50 some odd years, you have statistics that show that when certain things are the case related to that, you will end up with an extremely strong likelihood of a coming recession within some number of days. I think the average is 300 days or something. I really should pull up the statistics on that. But the big point is we have an equation that needs to be filled, which is the research really relates to a persistent inversion. So with a 3-month yield is higher than the 10-year yield for at least 10 days straight at any point, which says it's not just a little quick spike there. It sits around in that area for a bit, and maybe for much longer than that. But statistically, when that's the case, 7 out of 7 times within the next few quarters, you're going to move into recession. That's over the last 50 some odd years. So this past time that we saw it, it did not stay down there for very long. It popped right back up. It is positive now, not by a lot, 6 basis points. It could dip back down into that zone, but it didn't fulfill that narrative. So we can't really say that we've seen the signal as far as definitely a coming recession. And so it's like a lot of things right now. There's a good reason for both sides of that initial kind of war of opinion that we talked about at the beginning, where there's people who really don't buy this cycle rollover idea. They're holding portfolios consistent with maybe a late cycle, but still strong bull market, which the market is showing positioning, and they're going to hold on to that because they don't believe that we've necessarily seen signals that the economy is rolling over into recession. And that's really what it would take to facilitate the shift from here into a clear and unquestionable bear market in equities. So they've got that on the one side, and the other people are saying, hey, no, we've seen plenty of signs. Things are slowing down in a way that we've kind of passed the point of no return. We're shifting into a narrative now that's about gradually seeing more and more data points. We see things like the U.S. I think is last or second to last, along with Europe in the recent Citigroup Economic Surprise Index in terms of how we've been doing relative to economic expectations over the last month or two. And so I think the U.S. and the EU are the two that are slipping the fastest relative to economic expectations. And that's another sign saying, hey, there's an inevitable process that's underway here. And I think this yield curve inverting and then popping right back kind of leaves both of those views sort of in play. And the other view would be that there's just a lot of cross-border flows. Because we're seeing weakness around the world and not as much weakness in the U.S., there is a fungibility to fixed income markets, so you can go ahead, as long as you can get the currency hedging terms of the forward contracts, you can go ahead and pick up the difference between Japanese and European debt. We talked about this quite a bit, and profit from it by buying U.S. bonds. So you're actually borrowing and lending to take advantage of the difference between the two rates, which tends to arbitrage the rates together. So in other words, U.S. rates are falling unnaturally far because of how things are going in Europe and in Japan. So there's that possibility. But again, you can see this, and just to keep muddling the picture, as one of those, oh, it's different this time narratives, when you've got a fact like, 7 out of 7 times when you see this inversion, you're going to get a recession. So I think if we did stick around for 10 days or more with that inversion, it would be tougher to make those arguments because that's a reasonably robust set. But, there are ways to frame that narrative as though we've got exceptional circumstances in play right now. But I wanted to clarify the yield curve inversion idea. There's a persistence factor. The persistence factor is important. We didn't see the persistence factor met last week.
Okay. Is there a magic number that you've seen or no studies?
The data says 10 days straight of having it inverted. I mean, that's, you can look at all these things as sort of arbitrary. Yeah, that's what the data says.
Huh.
And we got to, I think, 4.
Huh. Okay. All right. I mean, even that seems like such a low... I don't know.
It does, but it may be that it's more vulnerable unless it's 50 days. But we don't know because history is only so long. These things only happen once a cycle. So you have to amass an enormous amount of time to get a data set that has any kind of statistical viability. So it's really tough to get statistics like this. And right now, it just happens to be the case that 7 out of 7 times, every single recession, in fact, that we've had going back to, the late 1950s has been preceded by at least 10 straight days of an inversion of the 3-month to 10-year yield curve in the United States.
All right, and then is there such a thing as, let's say, it inverts 2 weeks from now for 6 days?
No.
No? Okay. I was just curious if there was such
a
thing.
You can do that sort of thing. Well, let's play this game further. So the 210 also has some statistics behind it, 2-year to 10-year, and there was a great example in, I think it was 95, where it dipped down, it inverted for a short number of days. I think it did double dip, just like you're saying, and then we took off into the late 1990s. Boom. So it could be horribly wrong. And, there was extraordinary circumstances then as well, and I would say that's a context that is, you couldn't be far afield from that kind of context in today's world. With the direction of interest rates in general and with the causes behind it and opening up global trade and we had the baby boomers in the prime, and I think we talked about this too. You've got this, demographics is an enormously important factor in this process, and in the late 1990s we had the baby boomers going through the period of their lives from age 40 to age 50 where their production and their household spending is going to be ramping up for everybody. And we're not too far from seeing that for the median millennial. And the median millennial is a bigger generation than the baby boomers. And we're kind of moving toward that now. So it's not crazy for people who think that this cycle could last another 10 years. Like that's not absurd. It may be that we've just really soft for a while, but markets are kind of running in front of it, and we've seen some of that action in equities, and eventually we start to get this period where you've got the biggest generation in the history of the United States really settling down, buying a lot more houses, spending a lot more money, having a lot of kids, and that unquestionably changes economic outlook. So We're not that far, but I think the median millennial right now is like 37 years old, which is crazy. But I mean, that's a big predictor of inflation. That's a big predictor of economic growth. And we're kind of, we're not too far from that. And if there is kind of a rescuing situation, if we move into a recession, you start to feel like things are really bleak. You start to realize we've already blown our fiscal wad ahead of it. The Fed's got to do all sorts of extraordinary things. Gold is booming higher. Everybody's really depressed. And you've got this next generation coming into being sort of like the baby boomers were for the economy in the 1990s. That's around the corner. So there's an optimism note for economists.
All right. Well, are you still involved in your 30-year short?
No, I'm not.
Okay.
And yeah. And at the end of the day, I didn't make much from it at all. And it was just a kind of cycle play, and we'll see what's going to happen with it. But, it came back all the way pretty much.
All right. And let me get your thoughts on crude oil. You haven't been trading it too much. I know you had this somewhat bullish bias, and it was just like that China trade. We kind of missed it.
Yep.
And I guess where is that kind of top end of that range that you were looking at that maybe this gets a little overextended? Is it well above 70?
No. I mean, I would say that the area to look for is probably around 64.
Oh, so we're not too far away.
No, we're not. I mean, when we talked, I think we talked when it was back around 55 and 56, and we were kind of both looking at that area from 62 to 64 as a possible move. And we've made that move. If there's something arguing against, shorting at that point, is we still really haven't rebuilt that large speculator interest anywhere near to the level that we would typically see. So this is a directional trend we're seeing right now. No matter what you think about crude oil, on a monthly chart, if you look at a daily chart, we have seen, I think it was like maybe the strongest performer of major assets during Q1 of anything. And it is really charging ahead. A daily chart since mid-December, it looks like an extremely persistent upward trend. Anytime that we have seen a multi-month extremely persistent bullish trend in crude oil over recent years, you generally get to a situation where CFTC data on large speculators is something in the neighborhood of maybe 650,000 to 725,000 as far as the net long interest in the futures market. And we're way down at about 430,000 now. And I think the low we got to was somewhere around 300,000. So we're maybe just sort of halfway there in the process of cycling in the type of enthusiasm and positioning that normally leads to vulnerability in oil. It doesn't have to get there. I mean, it may be that there's just, like, if we start to see cyclical factors that, again, continue to reaffirm a slowdown type of environment, and maybe that accelerates a bit, then it would be difficult to see this. But I will remind people that it was crude oil in 2008, in the middle of when we were well into recession, already in that catastrophic, global financial crisis and the deepest recession we'd seen since the Great Depression. In 2008, crude oil moved from, I think, around $85 to $147 a barrel by mid-year. So right in the middle of this massive decline in economic activity through Q1, through Q2, into Q3, it just launched higher. So for people who think, well, the economy's rolling over, one thing to do is short crude oil, like, it can happen that trade can blow up in your face terribly. And that's because there's two sides to the equation. Sometimes, suppliers are going to stop sending supplies out there at that point because they're making the same prediction, and you get a little bit more demand than you're expecting. It's about an input-output ratio, not just demand. So we're already seeing, OPEC put out reports that, supplies are dwindling coming out, and that's, I think, what's powering this. And this trend, in other words, this trend could end up maturing or blossoming above 65, maybe even, as you're saying, up to the 70 level if we do get that type of move in large spec interest. And we continue to have a crack spread that's just giant. So you've got this persistent incentivization for refiners to refine that next marginal barrel of oil. I think this week's data for crude oil was the first time we've really seen a break in that data trend. We had several weeks straight where we saw big draws, big unexpected surprise draws, and I think that was that sense of this. We've quadrupled the crack spread since December. We've quadrupled since January. We've quadrupled it. We've quadrupled the incentive, the financial incentive for a refiner to buy more oil and turn it into gasoline. So that's big, and so refinery demand is going to probably continue to be really robust right now, as long as that crack spread, as long as that profit margin maintains itself at such high levels.
I do want to note that I just put a Fibonacci retracement on a weekly oil chart here, and
where are we at?
We're getting close. It's right around 64, where the 38.
64%?
Yeah.
No.
The 38.2 level.
Okay.
So can you see
61? Well, isn't that 61?
Well, it depends which way you're looking at it. So it's
yeah, right. Well, I mean, of retracing the move off the highs.
So
more than halfway now.
Yeah, so we're above the 50% and getting back closer to the 38.2 level on a retracement back up. So we're probably thinking of it inversely, but anyway, I did just highlight that, and when it lines up with a level that you thought was a pretty big level, I definitely take notice, and it becomes more relevant.
Well, you've got the trend line. You got the trend line from if you look back at the major lows, from the low back in late to early 2016, when we had the big blow up in the oil sector, and then the low that we saw in June of 2017. If you tie those two lows together, you've got a trend line that connects them up, and we broke that trend line last November, dove through it, and the underside touch of that trend line comes in at about 64, and that's one of the benchmarks I've been looking at, and that would tie right in with that 61.8%. And commodity traders do tend to use Fibonacci quite a bit, so a combination of those factors probably means that there's what positions are on the table. I would imagine we would see a reduction in spec long interest at that level. Whether or not we see selling that interrupts the trend is another issue, but I would say that's probably going to be something that's on everybody's radar.
Okay, well, we're only $1.50 away from that $64 level right now. It's not doing a whole lot today, only up 6 cents, but just out of curiosity, do you remember when crude oil traded, it hit that 147 level? I believe it was shortly after the markets closed, and it was overnight. I don't know if you were trading during that time.
Yeah, right. I remember, even in 2008.
Yeah, in 2008. I'll tell you what, if there's such a thing as a nightmare scenario in the in getting wiped out of shorts, that would be it.
Oh man,
because
brutal.
People were gone. It was late in the afternoon. The stock market was closed, and I just remember that thing flying just crazy. I mean, it might have been 30 or 40 point moves just in that overnight span. It
was insane.
Yeah. So. Yeah, be careful because
it could do that to you.
Yeah, it sure can, and that's what we talk about.
Especially when everybody sees the economy falling apart, and it's how can crude oil be going up, and it just goes up another 20% in a few days and just wipes people out.
And guess where when it happened? When the liquidity was the lowest. Everyone had gone home for the day. Pit trading was closed. I believe the electronic exchanges was just about getting ready to close. I think the bond market was done, the stock market was done. It was just insane. So to your point, yeah, that thing flew $20 in no time, and I remember people getting hurt pretty bad. Fortunately, I was a spectator watching that thing move, but and not involved. That's one of those scenarios I can't handicap it. I just stay away, wait for the next day, live to fight another day.
Sure.
All right. So just to bring it back to equities chart, looking at this thing trading close to session lows, I'm going to highlight the NASDAQ because that seems to be your vehicle of choice when you're getting involved. Has it dropped enough to get you enticed to maybe think about putting on a position?
Well, I mean, we've got a relatively low level of participation in a lot of White House-related headlines, so I'm a little bit less inclined just on those bases. But the NASDAQ has been the persistent relative weakness play so far today. So if I were to buy, I would look for maybe a level in the NASDAQ and then play either the S&P or the Dow futures.
Okay.
So, yeah, I mean, I just don't, I don't have a setup right now that's on my radar.
Okay, and same can be said for any other market right now, just sitting on your hands for a bit?
At this moment, yes, but that could change in 5 minutes. I try to say that. I've done that before where I say, yeah, I'm not looking at anything. And then I see something 5 minutes later, I'm like, wow, that's perfect. And then there I go. So it's really, it's tough. A lot of the decisions that I make really are about just kind of an intuitive recognition algorithm that I suppose is in there. And, you know, if I recognize this meets everything, then I look into it more and act on it. And it's just a sense of risk reward and recognition of pattern setups.
Well, always prepared you are, I will say that, and you break down all these trades probably in a number of ways well before you actually even get involved in it. So, and I know there's been times, Chart, that I've asked you got any trades out there, and you're like, nope, and we get off the air within 10 minutes, and you jumped on something. So things can change, and that's the way the market that's the way the market goes, right?
Sure, they can change very fast.
All right, Chart. Well, as always, thank you for jumping in. I always learn a lot when we talk, and if anybody missed anything, the good news is we got it recorded for you, and you can check it out on the playback. So we'll post that later on this afternoon. Chart, thank you so much for joining us, and I'm going to keep you on in case you do change your mind in 5 minutes and want to post a trade.
You got it. Thanks, Jim.
Thank you. Hey Brett, if you're still on, there was a feedback question.
Yeah, I'm still here.
Okay, so the feedback question is, with the movement in oil, why are oil stocks doing so poorly, especially with lower standards due to Trump and tax advantages? Do you have any take on that?
Are they doing that poorly?
Well, let's take a look.
You know, given a larger context view, like relative to the December lows, I guess they're lagging a bit, and I would say that oil stocks aren't the same as oil in a lot of ways. And the profitability for these companies has to do with a lot more than just the price of oil. Mm-hmm. And, you know, if we have a lot of cyclical doubt right now, you've got a lot of people who are in safety plays. The latest fund manager survey came out and said these guys are really just in defensive allocations, and we're not getting a lot of really cyclical, highly cyclical plays. And so if we were to see an inflection in terms of how larger money managers are viewing the cycle situation right now, if we do that, get that capitulation of the side of folks who believe that we're headed into recession in 2 to 4 quarters, if that shifts, that sentiment around that idea shifts, then I would assume that we would start to see the more cyclical side of the market outperform. So I think that it's really just a reflection of sentiment about stocks more than anything. And it may be an opportunity. If we do have that move that this was a quote-unquote mid-cycle slowdown in Q1, and we're starting to pick up out of it, and we're starting to see strong economic backdrop for the rest of the year, you know, I would think that we would see a game of catch-up there. But right now, I think that the sentiment situation in the market and the fund flows data just suggests that people are not going to be, but to the extent that they're buying stocks, they're going to be favoring things that are less cyclical. I think that that's what you're seeing. I think it's essentially a sentiment indicator.
Interesting. All right. Well, I'll tell you what. This is a nice-looking chart setting up in the XLE daily chart. Looks like one of your favorite patterns with the ascending triangle.
It is, except we had the higher highs in the middle of the pattern.
Yeah, I see that too. Yeah.
We kind of, to the extent that the idea is that we're blowing out people who are betting against this, but you can see that. You can see an ascending triangle with higher highs toward the end. I've seen that pattern work well. So we definitely have a steep baseline of support. That pattern is there. If we move back up above that, 67 area roughly, maybe 67.25, then yeah, that would look to me like a strong breakout setup.
All right. Thanks a lot, Chart.